Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 16 in our series for 2024, and today's date is Friday, May the 17th. First, I'll be talking to Nick Smith, Vice President and General Manager, Asia Pacific at Smart Communications, on how to learn more about some benefits and potential issues of ChatGPT and AI in financial services. And I'll be talking to AMP Capital Chief Economist Shane Oliver about Australia's latest inflation figures. But first, let's talk to Nick Smith.
Nick, generative AI has a massive impact on the speed at which content can be created with personalisation and the way information is shared with customers. How will this affect the financial services industry?
I think it's a really interesting question because AI is still very much in its infancy, and there's no doubt that the capabilities will help banks, insurers, wealth management firms automate processes, augment humans, and replace, recalibrate, and redefine some of the tasks and activities in their businesses. But equally, each of those sectors within the FSI sector are not homogenous. You know, banks and super and insurance have different types of relationships with their customers, particularly around customer frequency. But all of them share the challenge around engaging with their customers, educating their customers, and using AI in a way that creates value. You know, if you look at superannuation, engagement with the younger customers is difficult. So I can see how they can simplify their language and engage and educate their customers over the life cycle with AI, because they can do more frequent communications on broader topics much faster. In the banking sector, just off the top of my head, I think you can see a lot of the processes that are currently frustratingly managed through a call center will become automated. So self-service will go up for customers, and that will actually free up the staff to have those valuable conversations with customers as opposed to just be sitting on the phone answering simple queries. And then insurance, you know, you could see that the AI can help automate things like a claims process to make it faster, quicker, better. So there's lots of opportunities, and we'll see how it goes, I suppose, is a short answer.
There's been lots of speculation over the years about how AI is going to take a lot of jobs away. And suddenly, you know, we're told we're not going to have bank tellers anymore, for example, et cetera, or insurance processes. But at the same time, I would hazard a guess that AI would actually create jobs because you actually need human intervention in a lot of AI work. Would that be right?
Yeah, I would agree totally. And I think fundamental, particularly to the banking sector and the financial services more broadly, is this concept of trust. We as humans are very quick to spot insincerity, lack of authenticity, a level of automation in processes that frustrate us, and we want to speak to a human. So I think as AI evolves, those lower value manual tasks that are very repeatable will become automated, and you know, maybe you have a chatbot managing that for you. But when we as a human want to have a conversation about something difficult or challenging, you know, we need to speak to humans. So I think AI will actually free up staff to have those more valuable conversations and perhaps provide a level of differentiated service that we sort of lost over the last few years with things like automated calling into the call center where you wait there for 15 minutes to go through 7 buttons to get to somebody. I think that will probably get disrupted by AI.
But at the same time, you could have a better quality of service with the AI.
I agree. Yeah, I think you can, and I think probably the word here is potential. I mean, it's really interesting that I was actually reading an article today on the BBC website, and in Italy, they've just banned ChatGPT, and they've given ChatGPT, I can't even say the word GPT, 20 days to respond to their concerns. And their view is there's no legal basis for the mass collection of storage of personal data for the purpose of training algorithms. So I think we've got a long way to go in terms of how AI is utilized and the value it brings.
I mean, I find that interesting because I've used ChatGPT and I find that the wording it produces is, well, it's word perfect, the grammar is perfect, the spelling is perfect, but it's mechanical and bland, and it needs human intervention.
I agree. And I think that authenticity is key in communications, and you will always need humans to personalize the language to a way that, you know, resonates with us as individuals. I think that's very valuable. But we've also seen, in the early days of AI that it's not very good with dealing with bias or complexity. And so there are risks in it as well. So certainly for a company like ourselves, we can see the generation of pros, the automation of processes being very valuable, but we also feel you have to have humans involved to validate and check, because ultimately in the highly regulated industries, you don't want to upset the regulator or your customers, because both would have expensive consequences.
So you would need a human to actually check everything that came through to make sure, one, it's correct, and two, there are no inherent biases in that. Would that be right?
I would suggest that's absolutely accurate, yes.
But I mean, there are other issues because unaltered content can be created and shared with customers. And that is a huge risk for the financial services industry, isn't it?
It is. And for us as Smart Communications, that the way our technology works is it allows us to be a gate into the broader community. So you can create your content behind closed doors with, let's say, AI, with your own template creation, with your own staff, and then you release it in a secure and governed and managed way. So you sort of prevent the compliant, risky conversations going out unnecessarily. So that's part of the value we bring to the banking sector.
At the same time, you would need to have people who can actually manage that, control that, which would be a huge issue, I think, in financial services sector, to actually employ people who can do that.
Well, I think most banks, insurers, superannuation funds already do that today. Some don't always get it right, as we've seen in some of the messaging in the past and some of the company communications that have gone out. But generally, our view of the world is we sort of provide a technology layer that gives the organizations the ability to push the content to the subject matter experts in their organizations. And so the legal team gets to review the legal content, the marketing team gets to review the marketing content, the brand people, the brand content, and they can all do that very quickly. And then, of course, the specialists around the regulatory environment would also get access to their content as well. So,
but I would say that there's a high risk to that. I mean, if say, for example, the wrong recommendation goes out, you could actually have enormous reputational damage and legal damage to the financial services firm as well, with litigation and bad publicity and court cases. Would that be right?
Yeah, I think that's actually the fundamental risk with AI is that, we might have organizations pivot too quickly and rely too heavily on the tools. And that runs the risk, particularly around more complex products or complex calculations of producing the wrong information. So again, that human intervention before the communication goes out is very, very key.
Okay, but it would actually be quite pivotal for any insurance company or any financial services firm, wouldn't it?
Yeah, it really would. And, I think for us, we would look at the AI world in general as being very positive in potential. But at this stage, we'd sort of say, explore it carefully, proceed with caution, and have a group of people in your organization who are tasked with looking at the opportunities, creating a discovery roadmap around what processes could be made better by AI. But understand the scope and skills and the risk of doing this. So I think it needs to be a strategic conversation in the big FSI companies to ensure they've got an understanding of how they want to use the tools, and also the risk, to identify the risks and mitigate those risks as they start exploring them.
But at the same time, how cognizant is the financial services sector of these risks?
I certainly think in Australia, we've seen over the last few years, we've got a very tough regulator. There's been a couple of $1 billion fines for different things in the financial services sector. There's been restructuring of how banks operate in terms of their wealth management and insurance offerings. So I think that the banks and superannuation funds and insurers in Australia and New Zealand in particular are very aware of their regulatory risk. They're already massively burdened, if that's the right word, with complying with many different types of regulations. So I think they will look at this technology as potentially transformative with lots of benefits, but they will go carefully for exactly the reasons you've highlighted.
Well, Nick, we'll watch that quite closely. And look, thank you very much for your time.
No problem. Thanks, Leon.
And now let's talk to AMP Capital Chief Economist Shane Oliver. Well, Shane, inflation came in at 3.6% and the trim mean was 4%. What's your take on it?
Well, those numbers were a little bit higher than expected when they came out a few weeks ago, not dramatically so. I think the market expectation, the Reserve Bank was expecting 3.5 for the headline number. turned out to be 3.6. Of course, the trim mean was more worrying. It was about 0.2% higher than expected. And of course, that had the effect of the Reserve Bank revising up its inflation forecast for this year. But I don't get the impression that the downward trend in inflation is at risk. I think what we're seeing here is a bit of volatility. Some of the items that surprised on the upside were seasonal, for example, education and health. Some of the other areas are longer term problems, but the broader trend in inflation is still down. We have come down from around 8%. We're now 3.5%. And I think that trend will ultimately continue, even though the Reserve Bank is a little bit concerned about the rest of this year.
Okay, but the Reserve Bank kind of made the point that rates might go up, and indeed, let's see. There's been projections that rates could go up to 5.1%.
Yes, some economists are saying that, but it seems to be a minority. That doesn't necessarily mean that they're wrong. There's lots of views out there. I guess our view is that is a little bit more sanguine, and the Reserve Bank ultimately left interest rates on hold, despite some predicting that they would hike. I think the Reserve Bank took the view that, yes, those numbers are a concern, but they've already hiked enough, and they still see inflation heading down through next year and the year after to the midpoint of the target. So the Reserve Bank hasn't changed its medium term or its further out inflation forecast. It's really just changed this year. So I think it's unlikely the Reserve Bank will hike again. There is a risk there, particularly in the short term if we get another upside surprise on inflation. But I think the more likely scenario is that as inflation resumes its downswing, the Reserve Bank, for example, was assuming that there wouldn't be much continuation of electricity price rebates or subsidies by governments, whereas already Queensland and WA have announced continued subsidies, and there's likely to be something in the federal budget as well, at least for pensioners. So that I think on its own would knock a little bit off inflation over the months ahead. And ultimately, as inflation continues to trend down, we think the next move in rates will be down, probably later this year, but you can't rule out that it could occur early next year. And looking at the consensus of economists, they seem to be split. If you look at most of them, I think the median expectation was that there would be a cut at the end of this year, which I think is in line with our view. But of course, there is a significant group saying next year, and there's one or two saying, yeah, we're still going to get more hikes. So obviously a range of opinions there, but I think ultimately as the economy continues to slow, that'll drag on inflation, clearing the way for the RBA to cut.
Well, yeah, indeed, as you say, as the economy slows down, it will see inflation fall because people will be spending less.
That's right. And you can see that in consumer spending numbers. Yes, we saw an upside surprise on inflation, but if you look at consumer spending numbers, and we've had 3 releases over the last couple of weeks in regard to that, nominal retail sales very weak in March after a swift lift, Taylor Swift lift, if you want to call it that, in February, which was a very minor one. Then we saw the retail sales volumes numbers for the March quarter. They were negative again, worse than expected. That's down 5 of the last 6 quarters, and on a per capita basis or per person basis, retail sales have fallen for 7 consecutive quarters in a row. And a broader household spending indicator that the ABS puts out also points to softness in the March quarter. So it looks to me like consumer spending is suffering, that will weigh on the ability of companies to raise prices, which ultimately will bear down on inflation.
Okay, so, but this is interesting because what we saw was some extraordinary figures, and they don't look like going down. Like rents were up the most in 15 years, and insurance premiums were up as well, and that they're going to keep rising.
They quite possibly will, but we've also been seeing some things going down. If we were having this conversation 2 years ago, we would have been talking about extraordinary rises in the prices of goods because there's a shortage of things. Car prices have been going up for the first time in years, clothing prices, household equipment, even electronic goods were going up in price, whereas goods prices have resumed their softness once more. And I suspect that ultimately services will do the same. Now, there are some areas where there's structural problems. Rents are one. There is a structural shortage of housing, and that's putting upwards pressure on rents as well as house prices. So that, yes, does have further to go, although I suspect that we will hit a bit of an affordability constraint there, and you'll start to see as we go through peak immigration levels, which I think will occur soon, so slower levels of immigration coming in, albeit still higher than might be desired from a housing perspective, that will take a little bit of pressure off. Also, as rents go up, renters sort of start to change their behaviour rather than one or two people per dwelling. Young people, there'd be more shared accommodation, more young people saying, well, this is too expensive, I'm going to stay at home with mum and dad a little bit longer. That's the sort of behaviour you often see in response to a rise in price, which of course is what rents are. So I suspect that will start to put some constraint on. I mean, it's not ideal. I'm just saying this is the way the economy works. That as prices go up, it has a negative impact on demand. Insurance is a lot more intractable, and of course that's a function of lots of natural disasters lately, floods and so on, which have caused more claims to come through. That will settle down as insurers start to get their reserves back under control, but there could be some more pressure there. But I think in other areas, pressure will start to ease. Other services related areas, some pressure will start to ease as the economy slows and people say, well, look, I can't afford to go to the restaurant as much as I could, so therefore I'm going to cut back to going less. Or I'm not, like we saw in travel. Travel was a big problem go back 18 months ago, and of course that's slowed down a bit as well. People eventually say, well, okay, I'm going to go for a cheaper trip. I've done my get out there and travel stuff, worked off the travel bug after the lockdowns. I'll settle for something cheaper now that it's so expensive. So those sort of actions start to take pressure off prices, even though some areas like rents have a long-term structural problem.
Right, but the other issue is wages. I mean, they're going up too.
Wages certainly are. The indications from various surveys suggest that wages growth may have peaked, around just above the 4% level on average. I know we do see some big headline numbers. The federal government has arguably added to this by encouraging higher numbers because it appeals to their base. And of course, that's arguably made things tougher for them because it probably means higher than otherwise interest rates, or at least higher for longer interest rates than what otherwise have been the case. Because if wages go up, companies say, well, that's a cost to us, we've got to put up our prices. So that is a concern, but some of the surveys out there suggest that wages growth may be in the process of peaking around or just above the 4% level on average. Yes, I know we've seen some pickups in some industries. Aged care looks like there's got another round coming through. But hopefully, if we see a somewhat lower increase in award of minimum wages this year, which decision will be announced sometime in the next month by the Fair Work Commission, then I suspect that will act as a bit of a signalling effect, in contrast to a year ago where those numbers came in on the high side for award wages and minimum wages having an impact on the rest of the economy. I think this year it'll be somewhat lower than it was last year, and that also will signal a peaking in wages growth. So yes, that's a concern, but as demand slows, as unemployment drifts up a little bit, as job vacancies diminish, and that's something we've also been seeing. We've seen 6 quarters in a row now of falling job vacancies, less headhunters calling people up to say, come apply for this job. That also acts as downward pressure on wages growth.
The tight jobs market, the tight labour market's another factor as well, isn't it?
The tight labour market is the main factor, which has driven the pickup in wages growth. A couple of years ago, there was lots of debate as to whether that would occur or not, but it did occur. It's just the way the market works. You've got a tight labour market, demand for workers goes up, they put up their price, which is the wage, just as it does in product markets. Demand goes up, limited supply, price goes up. Now what we're seeing with the rise in immigration levels, the surge in immigration, that's led to immigrants taking a lot of the vacancies away. So the vacancy numbers have been coming down, and that in time will mean a less tight jobs market, and therefore I think is broadly consistent with wages growth. Hopefully, this is still a big uncertainty, being around the top, and then ultimately as the jobs market continues to weaken, it should mean slower wages growth. But we're yet to see all of that flow through, and that's why there's still a lot of uncertainty about the services inflation side of the economy, and why most economists, including ourselves, have had to push out the timing of eventual rate cuts.
But you're saying a rate rise is very unlikely?
I wouldn't say very unlikely. I'd say it's a risk worth worrying about it. The money market has been waxing and waning on this. If you want to get some guide, a couple of weeks back before the latest RBA decision, it got as high as 60% probability of a hike by August or September. When I last looked, it was down around 10% probability of a hike. I think it's probably 20%. So if you're asking me for August or September. Risk there, I'd say, is around 20%. As we go out towards the end of the year, I think we'll get some lower inflation numbers, slower growth, ultimately clearing the way for a cut. So, yeah, near-term risks still on the upside. I don't see any cuts in August or September, but as we get towards the end of the year, I think it starts to swing around.
Yeah, I mean, it's interesting that the RBA's language is they're neither ruling out nor ruling in anything.
No, they're not. And there's a bit of a contradiction there because that can be interpreted as neither ruling in or out a hike or a cut, which suggests neutral. But their language in their commentary, their written language, and the commentary by Michelle Bullock suggests more upside risks because they said in the last meeting they considered hiking and they considered holding, but there was no consideration given to a cut. I mean, that suggests if that remains the case, there's the risks are still on the upside. And she has said, we may have to tighten again, we may not. Again, that's skewed towards the upside. So I think in the near term, you'd have to say the risks are more skewed on the upside, the downside. But then if we get better inflation numbers, then my understanding is, for example, that the Federal Treasury in the budget this week will forecast lower inflation numbers than the RBA. If those numbers come to pass, then it does open the path potentially to a cut later this year, early next year. Of course, there's a big debate around all of that. The Treasury will partly be basing its numbers on more cost of living relief designed to reduce measured inflation. Energy bill relief, for example, because it means less of a rise in energy bills, which take pressure off measured inflation, as seen by the ABS. Others say, well, if you give any cost of living relief to anybody, then that means fiscal easing, money being pumped into the economy, too much money relative to too few goods and services pushing up prices. So there's a bit of a debate around that one. But bottom line is, if we do get lower inflation later in the year, which I think we probably will, resumption of the downtrend, then that I think swings the risks for the RBA back towards cuts, even though right here, right now, the risks are still on the upside.
So that those cuts could come at the end of the year or at the beginning of 2025?
Yeah, I've been sort of thinking, well, maybe December for the first cut. It's obviously a long way away. We've got to see a lot of stuff before then. If not, then February. It's just worth noting that a lot of people say, well, we're seeing similar trends globally with other central banks delaying rate cuts like the Fed. True, but by the same token, the European Central Bank, by its own recent comments, the Bank of England as well, look like they might be on track for cuts around June, July. June for the ECB, possibly June for the Bank of England as well. And it's also interesting to note Canada seems to be on a similar path. They have somewhat lower inflation than we do. And of course, so far we've already seen Switzerland and more recently Sweden, the first two central banks to cut interest rates amongst developed countries. So even though there's been some delaying, the broad trend globally is still towards rate cuts. And of course, in the US,